Okay? All right, so let's go back to this. We have a new fancy thing. I'm going to be testing on you this today. So I can write, oh, I cannot. Hold on. No, wait a second. Okay. Yes. So like that. Hey. All right. So let's go quick because we have a quiz today, right? Let's go quick over that little bit that we've covered, and that's going to also help you to have it in your mind, right? All right. So right now we are talking about the master budget and responsibility accounting. We have a set of learning objectives that we'll go over. Okay, so we'll learn what a master budget is, how do we manage it, we'll prepare we'll learn how to prepare a set of budgets once we learn what are the components of that master budget. So what are we learning today? Operating budget and financial budget, how we prepare those two, right? Then we'll see what the sensitivity analysis and budgeting is and how we use it. Somewhat we've learned that before, right? And then the very last, we'll prepare performance reports for responsibility centers and account for traceable and common shared fixed costs. All right. So the first one, we want to understand why managers need and use budgets. What is the benefit of using a budget? So just like any other corporation, you, in your daily life, you do the same thing. You prepare a budget so that you can plan and control your activities, right? You can relate your revenues to expenses, and you can better understand what is your financial situation. So a big company like Amazon would do the same thing, okay? Either it's for-profit or non-profit organization, doesn't matter. All of them do budgeting so that they stop on top of things. So next, what is it for? What is the budget for? We want to incorporate our strategical and operational decisions in that plan, okay? So for example, if we want to update our technology, that would be a part of the budget. If you plan to do some alterations to your capital assets, such as replacement, improvement, expansion, and such, that's also a part of your budget, okay? The major benefit of having a budget to the manager is to be able to compare your actual numbers to what you budgeted before, all right? So if, for example, you have some process in action, something new that you're implementing, that budget is going to let you to correct some activities. So let's say you see already that for the month 1 out of that 12-month plan, you are going extremely over the budget. You have an opportunity to correct the action right there, right? Versus not having any plan and not even feeling whether or not you're doing well. Okay? All right. So how do they use budgets? So we'll start with the first one. We develop a strategy. All right. So it is a cycle, right? But you got to start somewhere. First, we'll develop some strategy. So let's say we are expanding our production line. All right. So we're developing a strategy of how and what is going to follow and how much money we need to implement this, right? So the next we'll come up with this plan. And the part of that plan is going to be a budget, right? A set of numbers that's going to tell us if I implement that production line, here's how well I'm going to do, right? Hopefully. All right, so the next one is an actual act, right? And control. So once I'm done with this cycle, I have an opportunity to get a feedback so that I can compare to my budgeted numbers. So once I'm right here, is this working? Yes. Once I'm somewhere here, I can actually gather numbers, actual numbers, and compare it to this strategy, right? All right. So let's look. What are the benefits in details? First, it's going to force our managers to plan, right? It's not just hypothetically, hopefully once I get this, it's going to allow me to get something else, right? We're going to have a set plan in mind where once I put this particular production line, I have that much money generated, and so that allows me to move forward to another part of the plan, right? So it's forcing a manager to plan. I have to plan to get those numbers on the paper, right? And investigate each and every detail of that plan. The next one, it promotes coordination and communication. Obviously, a budget plan is not just your CFO sitting and putting some hypothetical numbers, right, that he saw in his dream last night. It's an actual work and research, right? So I'm going to get maybe my chief operating officer, and maybe someone else, right, and maybe sales and such, and I'll get that massive amount of information that will allow me to put that budget plan together. So it allows to a lot of collaboration in between the people, right? And then we have this benchmark that motivates employees and helps managers evaluate performance against planned goals. To illustrate this in your mind, if you were, so let's say a store opens some branch, right? And I know that this branch should perform really well because the location is good and the interest is there, so it should perform well. So I analyze, comparing, right, looking at some comparable stores. I say, so they need to make $10 a month, hopefully much more, but this is just for the illustration. So if they make 8, they need to do some, that would be my benchmark, $10, right? And that's going to help my manager looking at that $10 to evaluate, am I doing well? Am I not doing well? How would I know if I don't have the benchmark, right? So that I don't have to close that store later on. All right. So now looking at the actual report. So we have a performance report. And we're talking here about the smart tool learning, right? The same company. We've been talking for a month already about this company. Lots to learn on it. So anyway, they are some e-learning business company, and we have a performance report for them. So let's look. It has 2 parts. One is actual, another one is budgeted. So interestingly, let's look at the very top numbers. We have number of e-learning services where actual is 19,000 and budgeted 20,000. What does it tell us? We budgeted more, right? All right, bad thing or good thing? I don't really know. What if budgeting more made me take money out of the other process, right? And isolate it to this process, and I didn't need as much. So that other process that I took the money from is suffering right now, right? Or could have done better. So maybe it's not that good. So let's see.
Can you not take the extra money that you budgeted and put it towards something else if you don't need it?
But if I'm budgeting, I'm hoping that I'm going to stay at that budget. That's the point of budgeting. You want to be as right on the money as possible, right?
But if you're like $1,000 and you budgeted over $1,000, wouldn't that be good because you kind of technically saved money rather than spending all of it, and then with that money that you saved, can't you put it towards something else?
That's one way of looking at it, but it's not necessarily the picture, right? It can be a good thing, but it can be also a bad thing. So let's look here, what's going on. We have a service revenue, right? Let's look right here. So our service revenue is 589 and 600. So what does it tell me? If I take my service revenue and I divide it by a number of e-learning services, what is it that I'm going to get? Yeah.
About UA per service.
Uh-huh. So if I take 600 and divide by 20, 600 divided by 20. So I have 30 that I budgeted, right? I'm going to just write it here. Oh my gosh, it's so inconvenient to write by this thing. Okay, so the other one is the actual number. What is 589 divided by 19? It's 31. So what does it mean? If I have an actual number that's 31, but I budgeted 30. I got $31, right? And I planned to get 30. Is it good or bad? It's good, right? So by analyzing the whole report, you can see where you're doing better and where you're not doing as well. So let's look further. So let's look, for example, advertising expenses. Look, we actually spent $550 less than we budgeted. Is it a good thing or not? Okay. Now, if you take your service revenue and your advertising expenses, the relationship is the same. It's 5%. All right? So although you saved a little bit because you were, because the number of e-learning services is less, interestingly, that the relationship between the advertising and the number of e-learning services is the same, whether budgeted or actual. So by analyzing a table like this, it can tell you a lot about how you're actually doing when you're compared to what you budgeted. Okay? All right. Let's look at next. Number 2. Understand the components of the master budget. So we had fun with this exercise. And I really need you to understand which one follows after which one. So let's look at that graph again. And you might see it somewhere. All right, so what are the steps that we take to prepare a budget? So master budget is, as it sounds, something much bigger than your regular budget. And in fact, it is. It includes so many different financial statements and supporting schedules for the entire organization. Okay, your master is like the major one. So what are the 3 budgets that it has? We have the operating budget. Operating budget projects sales revenues, cost of goods sold, and operating expenses. And it's your budgeted income statement, all right, in parts. And then the capital expenditures budget is the second one. This budget, it's the plan for purchasing different plants, properties, equipment, and such, whatever is the long-term asset. Okay, that would be your capital expenditure budget, long-term asset. And then the last one is your financial budget. This one helps you to plan for raising cash, paying debts, all right? So it's very much it's like somewhat a marriage, right? Of cash budget, budgeted balance sheet, budgeted statement of cash flows. So all of these wonderful statements is nothing but a projected number, right? Behind that projected number, there is a lot of research work. It's not just hypothetical, right, number. It's based on a lot of thinking, research, collaboration, and such. But they're not your actual amounts. They're budgeted amounts, right? All right, so here is the one. So let's look again. Our operating budget. Okay, on the very top, it's your sales budget. Then we have inventory purchases, cost of goods sold, operating expenses, and your budgeted income statement. All right? Then we said the next one is your capital expenditure budget. So first you'll create your sales budget, then inventory purchases and cost of goods sold budget, then operating expenses, and then your income statement, budgeted income statement. Once you're done with these four, you can say that your operating budget is good to go. You're done with it. The next part is your capital expenditure budget. What is in that budget? All your long-term assets, plants, equipment, such and such. Okay, so I'm done with two, right? Operating budget and capital expenditure budget. Now is my financial budget. What is it? What are the parts of financial budget? Cash budget, budgeted balance sheet, and then budgeted statement of cash flows. All right. So now let's try this. Anyone remembers? Which one is number 1? All right. Second? Ah, you. No. From here. I promise you, you're going to see it somewhere. Try from here. Try I'm sorry, just a second. Try to make a story so that you understand, right? I mean, from the paper. It's easy, right? Which one is second? All right. Third? Which one is the third? You're close, but maybe there, down there, a little bit. Huh? Which one? Who else is for income statement? Income statement once, income statement twice. Income statement it is. All right. Fourth? Good. What? Full thing. Yes. Okay, long-term assets. Okay, 5. Cash budget. Who else is for cash budget? He gives you an answer and no one agrees to this. Okay, number 6. Budgeted what? You sure? Why not statement of cash flows? Haha, yes, it is. That's right. So 6 is your budgeted balance sheet and then your cash flows. All right. So remember all of it.
So that's the steps in order.
Am I making a point that you'll see it? Huh?
Is it in order?
Yes. It's in order.
Yeah, so this is just the steps in order of how
To create your master budget. Yes.
So you have one after the other.
Yes. Yes. So one is going to allow you to create the other one. Okay?
This PowerPoint is online, right?
Nope.
The student one.
It's in your My Lab. I need to check. Maybe, yes.
Wasn't this under the homework we just did?
All right. So let's keep going. The third one, how do we prepare that operating budget? Okay, so let's see. What are the components and how do we put it together? So we have three components, right? We just figured that out. We have sales budget, we have inventory purchases and cost of goods sold budget, and we have operating expenses. Okay, so once we get all of these three together, they will feed into the budget income statement. Okay? The information that we get from these three is what we'll use for the budgeted income statement. Right? So let's look at this example. The first one we have is a sales budget, right? We said. So I put this little example on the bottom. Your sales budget is probably the most important one. It's your cornerstone, okay, in your master budget. So once I know my levels of sales, I know how it affects the rest of the budget. You see? So my sales are going to affect the rest, all other components of the master budget. So if you project it, once I have, I can put my sales budget if I have all the projected numbers, right? So what do I need here? I need my projected sales, right? Just as you see, it's a sales budget. So once I can predict my projected sales, I can move on with the rest of the budgets, right? So how do I do that? I need to analyze each of the product prices, right? That's another component that I need to get. And then I need to multiply it by whatever I'm expecting to sell, whatever the number of units I'm expecting to sell. Okay? So these two components might be given, might be not, but they are the ones that I'm using to put together my sales budget. So my predicted price and whatever the amount I'm predicting to sell. I multiply those two, and that's my projected sales volume, right? So let's look at the example. Okay, we have some credit collection, some cash sales, great. The point is that my sales budget, I can predict what is it usually that I have in April, in my cash sales, in May, in June, in July, and do the same for my credit, right? And then I'm going to sum it up, and I can predict that this 240,000 is what's going to be my total for April, July. So that's somewhat of your sales budget, right? So you could also think of it, we've done something similar to this. Your projected sales is what we've done with the break-even points, right? So you would use those tools right here, okay, to analyze, are you on target or are you not on target? So all those tools would be helpful here, once, right, as a manager analyzing it. Okay. So what's next? Next is the inventory purchases and the cost of goods sold budget. So the cornerstone was the sales budget. Now let's look at this one. So this budget is mainly going to determine your cost of goods sold. Okay? Once you have all the components together, you're going to be able to determine the cost of goods sold for the budgeted income statement. Another benefit of this budget is that you're going to be able to put together your budgeted balance sheet with the ending inventory, right? It's going to give you your ending inventory. And then third is what are your purchases for the cash budget? Okay, so how am I going to find this cost of goods sold? It's your beginning inventory, your purchases minus ending inventory. That's just for you, as a reminder. Okay? So given this, for me to find my cost of goods sold, I need to know probably my beginning inventory. I need to estimate what are my purchases are going to be and what is the projected ending inventory. Right? It's the same concept, just new idea. Okay, we're just going to call it budget and project all of it. Okay? So my purchases, my cost of goods sold, ending inventory minus beginning inventory. Here you go. You've got your purchases. Again, it's the same formula, you just rearrange it. Okay, so the second one, done. Let's look at the third one. Oh, I have an example. Okay. So let's look quick at this example before we go to the operating expense. So let's look again at Craig's Tunes. So this is an example of your inventory purchases and cost of goods sold budget. So what do we have? What are the components? We have our cost of goods sold. We have our ending inventory. Now all of these are projected numbers, right? We have total inventory, beginning inventory, and we find our purchases. So let's look again, 4 month. And we say that our cost of goods sold is going to be 70% off the sales. Okay, so I can estimate for each of the month numbers. My desired ending inventory is something. So here it's our 20,000 and 80% of cost of goods sold for the next month. Okay, great. How did I get that? That desired inventory is something that you derive from the company policy. Okay, so if the company's policy states that you can add $20,000 to 80% of the next month cost of goods sold, that's what you do, right? Okay, and then the next on the line is our total inventory required. What are we doing here? We take this inventory for the previous month and it becomes our beginning inventory for the new month. Known concept, right? All right. So now we have the second budget done. Inventory purchases and cost of goods sold. So let's look at the operating expenses. So once we have those two, we can get the operating budget, expense budget ready. So operating expenses budget is your estimation for the expenses for the operation, right, of the business. So for that period that we need to estimate it for, that's our estimation of the expenses. It's going to include all of the fixed and all of the variables for that particular period as the estimation. So what would be the example? That's our rent, some insurance, advertising, right? We saw the advertising as an example. Okay, so some of them are not going to be changing and we're probably going to be right with the correct number on the budget, but some are our estimation. Okay, so some of the fixed are going to be easy to spot and put correct number on the budget. Some of the variable might be harder to deal with. Okay, and to put operating expenses budget together, it's very helpful to look at the one that we actually had the last period. Okay, we can compare how did we budget it last time and what were the actual numbers, and correct the behavior. Right? Here's the feedback between the actual and the budgeted. And now that I'm putting my budget for the next period, I can correct that behavior and I can compare the budgeted and the actual. Okay? So what is the example? Let's look at an actual budget. So again, Greg's Tunes. Here's the operating expenses. What are the parts of it? We have variable operating expenses, fixed operating expenses. So what are the variable? It's commission expense, miscellaneous expense. Okay? We have it as a percent of sale. So this one can fluctuate, right? This is an example where it's probably going to be just a tad harder to evaluate and to put the correct number closer to the actual down. Now once I'm looking at the fixed operating expenses, I'm probably going to be better with this one. So my salary expenses, my rent expenses, depreciation expense, and the insurance expenses. Right? Do you see how it might be easier for you? You aren't going to lay off 50% of your workforce, right, in the next period. So it's easier for you to estimate. And if you are, it's easier for you to estimate. What is that salary that you're paying, right? It doesn't fluctuate from month to month. And the same for the rent expenses. If you have a contract for a year and you're doing a quarterly budget, it's very easy to put that number down. All right, so that allows us to put the total operating expenses down. So what do I do with the variable operating expenses and fixed expenses? I add them together, right? I take the total variable operating expenses, I add the total fixed operating expenses, and this is how I find my total operating expenses. All right? All right. So let's look at the bigger picture. Budgeted income statement. So in my sales budget, I found the total sales, right? The next part is inventory purchases and cost of goods sold. Again, I did some calculations, maybe following some of the company policies, right? Like for desired ending inventory. And that's how I put together my inventory purchases and cost of goods sold budget. And then at the very end, I'm going to put together my operating expenses budget. Right? So these are the three. All right. Now let's look at the budgeted income statement. So once I have all of these together, I can prepare my budgeted income statement. So let's look how are those three are used, right? So look at this. I have my sales revenue, right? We found that. My cost of goods sold, right? And then my operating expenses. So you see how putting it together is going to allow us to put this budgeted income statement together. Now this is something known to you. We also have components, such components as the contribution margin and the net income or net loss. So net income or net loss is going to let me see where am I standing with the budgeted income statement. Am I planning to have any net income? Right? Okay. Just a quick question. What is the contribution margin?
Or do you want just the variable?
Whatever you remember.
Sales revenue by cost.
Sales minus,
Minus cost of goods sold.
good job. Okay. So it's my revenue minus variable cost, right? Good job. Okay. So here you go. You've been waiting for this, right? S22.3. It's missing something. Here. That's a full picture. All right. So we have a seller who is a rock climbing shoe producer. So they expect to sell 8,500 pairs of shoes for 180 each in January and 3,500 and 190 each in February. Sales are cash only. We want to prepare a sales budget. Do you remember how the sales budget looking like? We have our sales price per pair, we have number of pairs, and then we have total sales. All you need to do is plug the numbers in, right? So let's practice. While you're practicing, make sure you understand what is sales budget, what sales budget components are. Yeah.
In the slide before, I thought it also included how much, what percentage we get. Right?
Well, that's what I'm saying. This one is only saying cash only, right? All sales are cash only. Right? So I'm predicting I'm only going to accept cash. Maybe I don't have the machine, so I know for sure it's just cash. Okay? So what are the numbers?
1,590,000.
Uh-huh. So for January, okay, it's 100 and, let me see if I have like the whole number or, oh, I have the whole thing. Okay. Oh, I have this. Ah, how cool. How cool. Yes. And just figure out how this thing works. Okay. Ah, yay. Okay. Number of pairs. Okay. So what is that you said?
1,530,000.
Bless you. Everyone got that? What about the second one? February.
665.
So I have 190 here. $3,500 pairs of shoes, and the total sales?
765.
So what do I do with these numbers now? And what is it going to tell me? So I got this. Yes, you're right. What is it telling me? What is sales budget for? I should expect this much of what?
So,
Sales revenue, right? Okay.
are we gonna have to be able to project our sales as well?
You might. Okay. So let's do next. Operating budget. So we have the same seller, cost of goods sold averages 60% of sales revenue. Company expects to sell 4,100 pairs of shoes in March for 260 each. Targeting ending inventory is 10,000 plus 50% of the next month of cost of goods sold. Okay, so while you're doing this, I have some questions to some students. Did I give you answer? Oh, no. Okay, yeah. Go ahead. Just want to see how you're doing. At some point, we need to give final grades, right? You good?
I don't know yet. You guys come back.
If you're socializing, please, on the topic. All right? Okay, so do we have any numbers? I like trading. Give me some numbers. Cost of goods sold for January.
639,600.
Nope.
That's more.
It's 60% of sales. Right? Numbers? 60% of sales.
You have to add the target and the inventory to get it. That's why we get it.
Target and what?
You have to add the 10,000 plus 50% to the cost of goods sold to get the answer. Because 4,100 times 260 times 60% of that is 639, 600.
I don't know, but it's not the right number.
Wait, so you take your
Guys, come on.
and you minus the 10,000?
I'm sorry.
Wait, like, where are you plugging?
So we did the cost of goods sold, right? We've learned that it's
Or is our cost,
it's something that's usually projected by the company, or predicted by the company, right?
are our sales just 4,100 pairs times the 260, or you have to add something else? Or include something else? And if you just focus on that, and then at times the 60%,
393,760.
are we supposed to include that one?
Hold on, don't say it.
No, I'm not saying it. Should bribe you people.
Oh, look at that. One second. What are we looking for?
How did you get 918? How did you get that 1 million?
Oh. You're supposed to know what that.
Well, yeah, it's a process, right? One budget after another, right? Well, it should be in front. You should be writing it down. So we found that for the January it was 1,530,000, right? And it says there is 60% of that, right? Everyone understanding where it's coming from? All right, so do that for the February. What is it in February?
What was February's?
339,000.
Yes? Everyone understands where it's coming from? Ask questions now, you might see it. All right. So desired ending inventory. We know that it's 10,000 plus 50% of cost of goods sold. What did you say it is?
No, I was just talking about February's cost of goods sold. That was 399.
Yes. So So what is the next number? We just discussed that. It's from your previous exercise, right? It's the second budget that we're making on the same story, right, for the same company. So we took whatever we found at the bottom there. It was 1,530,000 and 665. and we'll multiply it by 60% sale each. Right? So what is the desired ending inventory? 10%, 10,000 plus 0.5 of cost of goods sold for the next month.
469.
Your calculators are off today. Huh? How did you find that?
I multiplied 5 times February's cost of goods sold.
And what is the February's cost of goods sold?
399.
Oh, the next one.
That's right. So we took 399, we multiplied it by 0.5, and then we added 10,000. I'm not sure if you understand anything that I've written right now, but this is 29500. What about February? What are we going to do with the February?
Use the information at the top of March.
Yes. So what are you going to do there? You'll multiply your price per number of shoes you're planning to sell, right? And then you'll multiply that by 0.5, and then I'll add 10,000. How much did you get?
129,500.
500.
Yeah. 3,000. Yeah, 3,500. Oh, 800.
What's with the calculators? Do you understand how you get this?
543,000.
Where are you stuck? Who is not understanding? Which one?
Yeah, but
How do I get 3329?
right.
Okay, so I took in March, right? I have 4,100 and I have 260. So I multiply those two numbers, right? Then I take this number and then I multiply it by 0.5 and then I add $10,000.
5,542,000.
I have a question.
Yes.
Don't you have to calculate cost of goods sold first?
Yeah.
Yeah?
Okay, so what you did, 260 times 4,100 will give you the sales for March.
Oh,
By 6 to get the cost of goods sold.
yes. I just missed that. That's right. Cost of goods sold is 60% of your sales revenue. It's multiplied by 0.6 as well. Sorry.
So first you do the 1,066,000 times 0.6, and then you times that.
So you make this column as well for March, right? And we know that it's 0.6. So we take 260, we multiply it by whatever, 4,100, right? Then this will multiply by 0.6, right? Because it says here. Is this clear how we get the cost of goods sold? And then the next step, we'll use this number to calculate the desired ending inventory. Does it make sense? Okay, so let's do next. Total inventory required. How do we find that? What is the total inventory required?
Cost of goods sold plus any inventory. Plus purchases.
So 60%, that's like a very little thing, right? Like it could,
It's given to you, right? We said that it's either your company's policy or it's pre-calculated or you're gonna get it.
You're going to get that percentage, and that's how you know what's in times.
Yes.
Alright.
So then,
So it's not always going to be 60%.
yes.
So it's purchases plus ending inventory minus beginning inventory.
Well, we don't have any purchases, right? Do we have any purchases here?
Is that what we're solving for?
There's none, right? We're gonna, yes, for right now, we're not talking about them, right? We're just taking our cost of goods sold, we're adding our ending inventory, whatever we desire to have as an ending inventory. And that's gonna be our total inventory required right now. And that will include the purchases, right? Okay. So how do we find our total inventory required? What is it? What are the numbers?
So it's cost of goods sold plus desired ending.
Uh-huh. Okay, it's right. We're just adding the two.
All right.
Sorry. And that's the second one. We just added the two together. Now, how am I going to subtract the beginning inventory? What is it? How do I know my beginning inventory?
From the desired ending inventory of the previous month.
Okay, what am I going to do with the January?
So you're going to subtract 728, 800. Sorry, you're going to subtract 1127 by 728,000. So it's total inventory required minus beginning inventory of the last, beginning inventory of the last month.
I'm going to help you here. So to find my January beginning inventory, I'm going to take my cost of goods sold. I'm going to do the reverse. I'm going to take my cost of goods sold, I'll multiply it by that 50% the next month, right? By that 0.5, and I'll add the 10,000. Okay? For my February ending inventory, oh, we've done that. You know that already. Okay? So how did I get this? 219,500. Where did it come from? Yeah. Similarity? There is a similarity, right? Yeah, or you can calculate the whole thing. Yes. Okay, so if it's not given, then you have to calculate. But if you have the previous history, then you can just use that number. I mean, the previous budgeted number, not the history. Okay?
Wait, so for the, how do you get the beginning inventory if you don't have it?
So you're going to take your cost of goods sold, multiplied by this rule. Target ending inventory is 10,000 plus 50% of the next month cost of goods sold. The next month cost of goods sold.
So you're adding, you're doing
The
10
next, so
plus 10,000?
target ending inventory. What is an ending inventory? It's the beginning inventory of the next month, right? So you have a rule. Target ending inventory is 10,000 plus 50% of the next month cost of goods sold. Okay? You're trying to find the beginning inventory for January.
Why are you adding the 10,000 and not subtracting?
Why you're adding?
Yeah, because you're going backwards.
It's 10,000 plus 50% of the next month, right? It's just the rule. They just tell you that's how it is. Okay? All right. Wow, you're fast. I didn't think we'd cover that much. Next, number 4. Let's prepare a financial budget. So we'll go over a little bit and do a wonderful quiz. You'll love it, I know. Okay, so what is a financial budget? Like we said, it has a couple components. My financial budget is my cash budget, my budgeted balance sheet, and the last one is the statement of cash flows, right? So we talked a little bit about what are these components for. Now let's just revise quickly. The cash budget is my projected cash receipts and payments, right? That's your, from financial accounting, I hope you remember this. Okay? The budgeted balance sheet. What would be a budgeted balance sheet? It's your projected assets, liability, and stockholders' equity accounts. All right? And the very last is the budgeted statements of cash flows. That's your cash flows from operating, investing, and financing activities. Okay. So first is the cash budget, then budgeted balance sheet, and then budgeted statements of cash flows. 7th time today. Next. All right. So let's look at the first, cash budget. That's receipts and the payments, right? What we see on this budget are all the details of how to go from our beginning cash balance to the targeted, desired ending cash balance. Okay? And we'll have our 4 major parts here. That's cash collection from customers, cash payments for purchases and inventory, cash payments for operating expenses, and the capital expenditures such as long-term assets, right? Plants, equipment, all of those. All right, so all of our cash collections and payments always depend on revenues and expenses, right? So let's look at the, yes. So it's based on our operating budget. Let's see what is this cash collection from customers. All right, so we have 2 sources here. It's our cash sales and the collections of accounts receivable. Okay? So that's our sales. So let's look at the 2 examples here. Sales budget and budgeted cash collection from customers. So we have our sales budget estimated at $240,000, right? Now we also have our budgeted cash collections from customers, and that equates to $236,000. How do you understand the comparison of the 2? Why my sales budget is 240 and I'm predicting that the cash collection from customers is 236? What's your intuition here? Hypothesize. Make it up. So I have April and July, and my total of sales budget 240 for those months, right? And I'm expecting to collect cash for 236 in cash. Is it good or is it bad? Yes.
Customers might not pay.
Maybe they have some extension from us or something, right?
Or they just might not pay at all.
Or maybe they don't want to. Yep, that's right. All right. Okay. So look at this. We have cash sales for 60% as a budgeted cash collection, right? And then we have credit collections 1 month after sale at 40%. Okay? So the components of our budgeted cash collection from customers is a cash collection at cash sales at some percent, and then we have credit collections for the remainder. Okay? And we've done this. All right. So the next is our payments for purchases. So that's a new budget, another part of the budget. That's cash payments for purchases. So let's look at the example. Now we have another part that's incorporated here. It's our inventory purchases and the cost of goods sold budget. So let's just look at this really quick. We have inventory, we have cost of goods sold, desired ending inventory, total inventory in the beginning, and purchases already calculated, right, before we start calculating the budgeted cash payments for purchases. Now the new one is the bottom part, and here we have 50% of the last month purchases and the 50 of this month purchases. Can it be a different ratio, 50-50? It can be anything else, right? This is just to illustrate. So it can be 40, 60, 37, whatever that is. Okay? Okay. So this is an assumption. We'll assume that our purchases is 50%, the payments for during the month of purchase, right? Let me see. We'll start at 4. Okay. I hope there's a 50 here. Because it died on me.